Mario, I know you have been watching inflation very closely. I know you've been watching the Fed's reaction very closely. Last time we talked to you was a little over a month ago. What do you think now with another month's worth of data?
Nothing to change. The Fed is already doing two things. One, raising rates to catch up. And the second one is obviously to whip inflation now, which is a major challenge. And you see it at the pump. You see it at the food cost. And the second part is the roll-off. The roll-off is $47.5 trillion out of the $9 trillion, a billion per month, going to 90. It's 17.5 against mortgage-backed securities, going to 35 in August. And treasuries are 30 going to 60. So they're doing what they're doing at a glacial speed. And but from a corporate point of view, Becky, what do I look at? I look at units sold. I look at market share. I look at industry trends, but I also look at nominal revenues because that's where my revenues are and that's where my gross margins are being a little crimped. And you hear it every day. The second thing we're looking at is SG&A not rising as fast as nominal revenues. So I think profits are okay in nominal terms. In addition to that, you'll see the reports of companies that look at the balance sheet. Inventories have gone up, in part because while units have not gone up, the amount of dollars in inventory have gone up. And the question is that too much? If you have stockpiled lumber, for example, at $1,200, it's now $600. So, you're going to take some write-offs, but the market tends to ignore that. As far as the economy is concerned, yes, you're right. I've gone through cycles. How bad is bad? How long will it be bad? And then how good is good? And when it's good, what multiples do we pay? And with the higher embedded interest rates in the future, you're going to pay a lower multiple and lower EBITDA 2 or 3 years out minus CapEx. That's it.
All right, but let's talk about even the multiple right now. We have seen multiple compression. It's come down from, 21 or 22 down to 17 or 18 times earnings. That's multiple compression if you believe the earnings numbers. But there is this big debate about whether and how much the earnings estimates are going to have to come down, in which case it hasn't been as much multiple compression as we think. Where do you come down on that debate?
Okay, Becky, when I started, multiples in the 60s were 6, 7 times. You played cycles by having leading, lagging, and coincidental indicators in the economy. They had what they call, in quotes, the conglomerates. Then you had, when I started the firm in 1977, 10 years after doing sell-side research, and continued to look at in the stocks in that fashion, multiples were 3 to 5 times EBITDA minus CapEx. A year ago, you were looking at Bitcoin, NFTs, Robinhood. You're looking at multiple of revenues. Now you're looking at what's EBITDA minus CapEx, what's cash burn. So it's not only a multiple of what, in quotes, the S&P earnings, because that's the market aggregate, but I'm looking at stock specifics and looking at things in that fashion. For example, in the oil patch, which you had an extensive meeting on, look at the amount of CapEx that was put in by the majors and the independents over the last decade. I tweeted that, and you basically can see how CapEx declined. Why? Obvious. Everybody was saying they're going to cut off your financing, you're too leveraged, the price of oil collapsed. Now I find companies that are tiny, like Drillquip, the stock sells at $31. DRQ is the symbol. We own it for clients, and they got $10 in cash, and they're building out slowly. And then you look at some of the companies like the FANG, Diamond Energy, and you look at Calpine, which is smaller E&P producers. You kind of look at and say, will oil stay at a certain price? And what can I do? Should we have the equivalent of the Production Defense Act to help oil? Do we want to cut down? I'm not as worried about high cost at the pump. There are companies that I've talked to that are giving stipends to their teammates, their employees, for gasoline payments. But on the other side of the coin, in the 1970s, since you asked my history, we had to wait online for availability.